If you are looking at the silver chart right now, you are witnessing a crime scene in reverse. Yesterday, we saw a 4% drop that terrified the retail market. Today, we are looking at a vertical green line that has completely erased that fear. Silver spot price is currently trading at $8,023. It is up 6.17% in a single trading session. This is not a normal market fluctuation. Commodities do not simply jump 6% in 24 hours without a structural reason. What you're seeing on your screen is the definition of a failed bear trap. To understand the mechanics of this move, we have to look closely at the chart structure. Yesterday, the price was pushed down to $74. This was a calculated move to trigger stop losses. The algorithms hunted for the liquidity of weak hands, who were leveraged to the upside. They flushed them out. But today reveals the truth. The moment the selling pressure stopped, the price didn't just stabilize, it launched. This indicates that there was a massive limit buy wall waiting just below the market. Smart money, industrial buyers, and sovereign funds were sitting with their mouths open, waiting for that dip. And the moment they got filled, the supply evaporated. We have now broken a critical psychological ceiling, $80 per ounce. For traders, this number is a fortress. The fact that we smashed through it with this much volume suggests that the short sellers are now underwater. The banks and hedge funds betting against silver are trapped. This creates a feedback loop known as a short squeeze. When a short seller loses money, they have to buy the asset to close their position. Their buying drives the price up further, which forces the next short seller to buy. It is a domino effect. And looking at a 6% move, the dominoes are falling fast. But silver is not acting alone. Look at the leader of the pack. Gold just crossed a historic milestone, $454.77, up over 1% on the day. Gold is the general of the precious metals market. When the general takes new ground, the soldiers follow. But notice the difference in speed. Gold is up 1%. Silver is up 6%. This is the silver beta in action. Silver is waking up to the reality that it is undervalued relative to gold. At $80, silver is sprinting to catch up to a gold price of $4,500. The ratio is compressing. However, we must remain unemotional. Markets do not move in straight lines. A 6% day is exhilarating, but it often brings volatility. We might see a retest of $78 or even $76 in the coming days as traders take profits. Do not let short-term volatility shake you out of a long-term thesis. The chart shows a bullish engulfing pattern. This means today's buying completely consumed yesterday's selling. It is a technical signal that the momentum has shifted from the bears to the bulls. The trap that was set yesterday has snapped shut, but it caught the wrong animal. It didn't catch the bulls. It caught the shorts. But the most dangerous part of this story isn't on the New York chart. It is in the relationship between New York and Shanghai. Yesterday, we discussed the massive premium in the East. Today, New York rose $6. Did Shanghai drop to meet us, or are we just racing to catch them? This is the arbitrage game. And in the next part of this investigation, we are going to look at the industrial panic that this 6% move just triggered. If you are a solar panel manufacturer and you didn't buy yesterday at $74, you're waking up to a nightmare at $80. The cost of doing business just went up and the inventory is nowhere to be found. You have to understand what a 6% move does to the physical supply chain. For a day trader, 6% is a great profit. But for a global manufacturer, 6% is a logistical disaster. Imagine you are purchasing silver for a semiconductor plant in Arizona. You operate on just-in-time delivery. You do not hold massive stockpiles because inventory costs money. Yesterday, you saw the price drop to $74. You thought, great, the market is cooling off. I will wait a few days to buy cheaper. You tried to time the market. And today, the market punished you. The price ripped to $80.23. Now you're panic buying. You're not buying because you want to. You're buying because you have to. If you do not secure the metal at $80, your assembly line halts. This is the difference between investment demand and industrial necessity. An investor can choose not to buy. A factory cannot. This panic is what drives the arbitrage window we have been tracking. Yesterday, we pointed out a $12 spread between New York and Shanghai. New York was 74. Shanghai was 86. That spread was unsustainable. Physics dictates that the lower price must rise to meet the higher price to stop the metal from draining. And look what happened today. New York jumped $6. We are closing the gap. But notice something critical. We did not close the gap because Shanghai collapsed. We closed the gap because New York capitulated. The Western paper market is being forced to accept the Eastern physical reality. The real price is being set in the East, and the West is frantically repricing to stop the bleeding. But there is a secondary effect of this volatility that almost no one talks about. It is called the seller strike. When the price of an asset jumps 6% in a single day, physical sellers disappear. If you own silver bars and you see the price skyrocketing, why would you sell today? You assume it will be higher tomorrow. So you hold, scrap dealers hold, refiners hold, mines hold. Supply vanishes from the market exactly when demand is exploding. This creates a liquidity vacuum. Buyers are desperate to find metal at $80, but the sellers are waiting for $85. This widens the bid-ask spread and creates slippage. It makes the price action violent. We are seeing the breakdown of the efficient market hypothesis. In a normal market, higher prices bring more supply. In a squeeze, higher prices actually reduce supply because sellers anticipate even higher prices. This is the GIF and good phenomenon in financial assets. And right now at $80, silver is behaving exactly like a scarce asset in a currency crisis. The higher it goes, the more people want it. But we have to be careful here. Parabolic moves often have corrections. It is entirely possible that the paper markets will try to smash the price back down to test the breakout level. They might try to push it back to $78 to see if the support is real. But the industrial floor is rising. The solar manufacturers can no longer hope for $60 silver. That world is gone. They are now fighting to secure supply in the 80s. This raises the floor of the market. And as the floor rises, the ceiling gets blown off. In the next section of this investigation, we need to look at the monetary implication. Silver is surging 6%, not just because of solar panels. It is surging because the bond market is trembling. Gold at $4,500 is sending a warning signal that the debt system is unstable. We are going to analyze the safety trade. Why capital is fleeing from sovereign debt and moving into tangible assets. The derivatives market is starting to smoke, and silver is the fire alarm. We have to zoom out from the daily chart and look at the battlefield. Silver rising 6% is massive, but gold breaking $4,500 is historic. You need to understand the hierarchy of money. Gold is the Tier 1 asset. It is the reserve asset of central banks. When gold moves, it is not speculating on solar panels or microchips. It is voting on the stability of the global currency system. A gold price of $454 is a vote of no confidence in the US dollar. It is the market telling the Federal Reserve that they have lost control of the bond market. This is why the green candle on silver is so violent. Silver is a hybrid. It is half industrial metal, half monetary metal. When the industrial side panics, the price rises. But when the monetary side wakes up, the price explodes. Right now, we are seeing the monetary premium return to silver. For years, investors treated silver like copper or zinc, just a commodity. But today, with gold at all-time highs, investors are remembering that silver is poor man's gold. It is the only asset that is cheap enough for the average person to buy, but holds the same monetary properties as gold. At $80, silver is still incredibly accessible compared to a $4,000 gold coin. This drives retail FOMO, fear of missing out. And retail money is emotional. It chases performance. When they see a plus 6% ticker, they buy.